Good evening, everyone. This is James coming to you from Dividend Stock Talk, where we talk about dividend stocks and investing in dividend stocks for monthly and weekly cash flow. Today is Sunday, September 3rd. It is 10:30 p.m. and I know I'm on this 30-day challenge to do a video every day, and life gets in the way. I don't know what it is. I'm going to have to practice a little bit harder at it, because to me there are more important things than money. I enjoy sleeping. I enjoy taking naps. I enjoy walking in the rain, because it rained today. There's a lot of things I find more interesting than the pursuit of the almighty dollar. I've passed that point in my life. I just want to relax and just take in a little bit of money that helps me get by. Am I looking to make $1 million? No. Am I looking to make a couple $1,000s a week? No, just a couple $100. Keeps me happy, keeps me out of the house, keeps me busy, allows me to pass on my information that I've learned over the years. So today, I think I want to take a look at the four-corner credit spread. Look it up on Google. It don't exist. I was talking to a few investors a while back, and some guy mentioned something about a four-corner credit spread. And I'm thinking to myself, I've never heard that before. So I'm doing some research, and I'm looking. I can't find any information on it. However, I know how the concept works, and I know what to look for, but I've never actually done one. So today, I want to look a little bit deeper into a four-corner credit spread and actually kind of throw one at the wall and see if it sticks. So let's jump in and see what's happening this week. Let's jump on over to our spread. Okay, now if you haven't been following around, or if you're new, I like to trade 3 or 4, maybe even 5 different trading strategies. The credit spread, the four-corner credit spread, would actually be the 5th trading strategy I want to look at. And I do have different trading accounts for each one. I only show people the two main ones. One is the Dividend Capturing, which is just strictly capturing the dividend and moving on to the next stock. It's not as profitable as the spreads and the options, but spreads and options are more complicated and there's more risk. So where there's more risk, there's more reward. And you have to be okay with losing money, because you lose a lot more money trading with the options than you do trading with the dividends. Now, don't get me wrong, the options are still far surpassing the rate of return overall for the year than the dividend capturing, but it's not as guaranteed or not as steady as the dividend capturing. So, that being said, let's see what's happening this week. Okay, now we have our position. We only have one position this week, because we're still trying to figure out what we're going to do with Colgate-Palmolive. We bought 5,000 shares back in July, and what have we been doing with it? Nothing but trading, selling options against it, called a covered call, and we're making roughly around 1% of our total cash per week, which is not bad if you think about it, because 1% a week comes to 50% a year, or a little more than 50% a year, because there's 52 weeks in the year. So yeah, that's it's a nice return. Don't get me wrong, Colgate-Palmolive's been around for over 100 years. Let's look what they're doing. Okay, so like I said, Colgate-Palmolive's been around for over 100 years. They're on the Dividend Kings list, which means they've increased their dividend payments to their shareholders for a minimum of 50 years. So let's get the right one. That's SLB. I'm not looking at that. Let's go Colgate-Palmolive. Colgate-Palmolive starts the year right at 74, almost 75, drops right back down to 72, 73 area, trades there for a couple of months, drops down to a trading range of 66, trades there for about 4 months, jumps back up to the 73 area for about 3 months, hits the high of the year at 77, and then drops down to the trading range where it is now at 71. Okay, she closed at 71.30. Now, if I sold it this week at a loss, I'm still up for the year, because we're at, close to 51% return for the year. And I think I'm not going to hold it past the end of the quarter. because which will be the end of this month. I really want to get rid of it by the end of this month, whether I have to take the loss of it or not. Now, if I sold it today, I'd take a $13,000 loss, which is a 13% loss, which is kind of a big loss. Let's quickly take a look at where we are with Colgate-Palmolive. All right, we're down only 3.6%, which is not a lot if you think about it. But year-to-date profit and loss is $5,000, which would be our biggest loss. You know, other than that, Goldman Sachs was like 3,200 or 3,900. That's a big loss. But anyway, that here we go again. Ready? That being said, this is my account statement. It gives you all my profit and losses for the year. You know, all the trades that I made. Look at some of these losses I've had. Colgate-Palmolive, 5,100. You really can't count that as a loss because I haven't taken it as a loss yet. But Goldman Sachs took a bath of that one, almost $4,000. 3,700 on Chicago Bridge and Iron. Verizon, 3,200. Dollar General, Citigroup, Carnival, Hess, Discover. The list goes on and on and on. Okay, let's count them. Why not? Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9. 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 20 losses. That's a big chunk to lose. Okay. 20 losses. Okay, Jim. Let's see. How many wins we've had. All right. So 20 losses, and here we go. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47. Let's mark that. 47. Oops, 47, 48, 49, 50, 51, 52, 53, 54, 55, 56, 57, 58, 59, 60, 61, 62, 63, 64, 65, 66, 67, 68, 69, 70, 71, 72, 73, 74, 75, 76, 77, 78, 79, 80, 81, 82, 83, 84, 85, 86, 87. All right, so we lost 20 and we won 87. Okay. Let's take a look at our totals. The 87. All right, net liquidation is 240. That gives us 40,000. Buying stock, blah blah blah. Option buying power, blah blah blah. Total commissions. Ooh, look at that. 10,900 in commissions, fees. Ugh. Account summary. So we had a $51,000 profit loss year to date, but out of that 51,000, 10,900 is commissions. See right here, overall profit and loss 51,000, which is over 51%, which is about 51% because our account was $100,000, and then a $51,000 profit is 51% of 100,000. However, you still got to deduct that $10,000 in commissions and fees. That's a big chunk. But what's even more of a big chunk is $41,000 profit. That's not bad. Okay, that being said, let's jump on and see what we're doing. All right, Colgate-Palmolive, we're looking at the 74 ain't worth squat. Wow. Okay, so Colgate-Palmolive's at 71 right now. If I sold off at 71 now, I'd take how much of a loss is that? Let's go back to find out exactly how much of a loss that is. If I took the loss on Colgate, Palmolive, it's a $5,000 loss. Do I take that and jump onto the other trades and just keep on going and make it, an even 20 loss? Or do I just say, let's hold on some more and do some more covered calls? I could do the 71 covered call for 67 cents, which is, wait a second. $67 times 5,000. That's like a $3,000 profit, right? Okay. Where are we? Okay. Quickly, let's take a look at this. If we sell first thing Monday morning, the 71 call, right, for 67 cents. Okay, 0.67, 67 cents, and we multiply that times the 5,000 shares, that's 3,300. So we add that 3,300, we subtract that from the $5,000 loss, and we only have a $2,000 loss, and it allows us to jump on and do other stocks, move forward. That way we can get rid of this position, take the loss, pay homage to the great trading gods and say, hey, we were not right, but we're still profitable. No, actually, we did lose a little bit of money, some aren't. So that's a tough one. I'm going to sleep on that one because I really can't play the game if I'm sitting on the sidelines just collecting $1,000 a week, because I'm not collecting $1,000 this week. If I wanted to collect $1,000, then I would have to sell off the 72. If I sold off the 72, that would give me almost $1,000. That would 2,500. Wait a minute, 25 times 5,000. Let's try that real quick. 25 cents. Multiply that by the 5,000 shares. That give me 1,200. Yeah, I can take the 1,200. To 72, and if the stock goes up to 72, I'll get more value from selling the shares, and the 1,200 from selling the 72, which is less than ideal. All right, what does Colgate-Palmolive usually do this time of year? Let's quickly check that. Because seasonality, don't get me wrong, I don't base everything on seasonality. However, it's nice to take a look at it every once in a while. Okay, so here we are coming into Monday. It looks like Monday, Tuesday should hit a little bit of a peak, but then drops back off by Friday. So I wait until Tuesday to sell that. I can get a little bit more money. Okay, who knows? Anyway, that is that, now isn't it? Let's go back to the regular chart. If we break this down a little bit. Okay, here's where she is now. I don't know if you can call that a bottom because it hit here and then it went up. You can see right down there at the 70, 71 area. That could be support there. You can't really count this as support because that's it's like leapfrogging up to that trading range of 73, 74. Right now, this could be the new bottom. I don't know. We just don't know. Okay. Here we go. Let's look at 10 years worth of data. Now this is 10 years worth of data. You see where it is? Colgate is still, going sideways with an uptrend. Okay, so it's a good, strong, solid company. Am I going to lose by holding on to it and continually selling the covered calls against it, bringing in, $1,000 here, $2,000 there, off of the 5,000 shares? No, of course not. It's a great company, so why not hold on to it? But by doing that, I'm missing out on the other trades that I'm missing, Okay, that being said, let's see what else we're looking at. Okay, so that's the position we're in with Colgate. I think I might do that. Bring in the 3,300, get rid of the beast, and jump on to a different company. Because, I say, you don't lose until you sell at a loss, but there's always the missed opportunity loss. Okay, so here we've been holding on to Colgate-Palmolive. Let me bring up a calendar real quick so I show you exactly what we're doing with it. All right, let's go back. August, July. Okay, we're going to go back to July. Now, we bought this the first week of July. All right. Now, we sold the covered call the first week of July. We brought in like $2,000. I think it was $2,600 the first week. And it was like $2,100 the second week, and then like $2,000 the third week. Plus the dividend, because we bought it 10 days prior to the EX date, which was right here. 10 days later, you get the dividend. The dividend, I think, was like $2,600. So you get the $2,600 from selling the call option, another $2,200 from selling the call option again, and the third week it was $2,100 for selling the call option, and then another $2,600 for collecting the dividend, and then we get another $1,000 or $2,000 the next week, the last week of July, and then we come into August. We got $1,000 in the first week of August, $1,000 the second week of August. We didn't get anything the fourth week of August, $1,000 the fourth week of August, and nothing on the fifth week of August because, again, we held on. We sold, I think, a 2-week spread because the 1-week spread wasn't enough. So by continuing the covered calls, we made close to $8,000 to $10,000 on this stock already. So take the loss on the stock and do it one more time. Bring in the $3,000 for the here we go. Let's be just done and over with. 67 limit. This is not going to fill until Tuesday morning anyway. So that's going to give us $3,300. Okay, so if the stock closes above 71, we're out and with $3,300 richer. Subtract all that from our loss, and it's not as bad. Alrighty. Or we could sell the 71.5s. Let's see what the 71.5s look like. All right, so the 71.5s is $2,000, $2,100, okay, and then that extra 50 cents times 5,000, another $2,500. So 2,521 is 46. That pretty much takes care of our what do you call it? Our loss. So let's do that. And there you have it. It's done. It's rolling. Okay, we talked a little earlier about the four-corner credit spread. Now, a lot of people saying, what is a four-corner credit spread? Anytime you look at the chart, the options chart right here, let's open this up a little bit more. Here we go. That too much? I think that's too much. 14 should be enough. Give you a good idea what's going on. I'll get rid of that stupid line. All right, anyway, it's highlight right there. All right, so the stock is at this moment in time. The last trade on the stock was 71.30. So you have a line right here. See, it's black up in this section, purple down that section, black down this section, purple in this section. So what is that? That is your horizontal line, or the at the money line. That's where the stock is right now. It's at the money, which is where that line is. So if you think about it, at the money, you have the horizontal line, which breaks it, this whole chart, into two sections. Anything above and anything below. That's two sections. Okay? So this is everything south and this is everything north. Now, over on the left side are all your puts. And over on your right, so reverse that. Everything on the left side are all your calls. Everything on the right side are all your puts. So you have a vertical line right here, which represents a separation between the calls and the puts. Then you have your horizontal line, which represents everything in the money and everything out of the money. Okay? Everything in the money here, everything out of the money here. Everything in the money here and everything out of the money up here. Okay? So, that being said, the four-corner credit spread would be selling one up here, selling one down here, selling one up here, and selling one down up here. It's a four-corner credit spread. Each corner is covered. So what kind of a trade would I do on this? And here's your spreads right here. The four-corner credit spread. Okay, so if the stock's at 71 now, so it's right here in this area, 71, 71.50. I want to make a trade on this. That's going to be more profitable than not. How would I do that? Well, that's a good question. So I can sell that. Now let's make it interesting and do 20 of them. Wow. Am I reading that right? The buying power effect is 0. They're actually letting me do this credit spread, and it's not costing me anything. So what is the pros and cons about that particular trade? Oh, that could be tough because I already own this stock, so that might give me a false reading. So let's find a stock that I don't own. Let's get one that we have a pretty good idea of which direction it's going to go. Today's the 3rd. So let's look at something from this week. So 10 days would be the 18th, 19th. But we don't want to go that far out with a credit spread, so we still want to do what's closer in the money. Oh, there you go, Harley Davidson. We looked at Harley Davidson. As I recall, they weren't paying very much. Hewlett Packard, LRC. Look at Merck. Why not? Okay. MRK. Okay. Merck looks pretty good. Oh, look at that nice uptrend. Gotta love it. Now, see, Merck, we looked at last week. So if any guy's paying attention that were here last week and you got into Merck last week, like I didn't tell you to. It was a suggestion. All right, let's trade Merck. Okay. Let's get out of that. Let's go look at the seasonality real quick to find out what Merck is going to look like. Okay, here's what Merck's doing right now. And it's, you know, a little bump at the beginning of the year, a little uptrend here. Okay, it shows an uptrend here, but as it actually dropped there, but it continued going up and up and up, and now it's going sideways, which is a sideways market. It's right about here for the seasonality part, and as you can see, it's settling into the seasonality part right there, this sideways. So what are we looking at for the next week or so? All right, the next week or so, we're looking at sideways. Okay, so we want to do a four-corner credit spread with the stock going sideways. All right, so it's not going to be any big movements up or big movements down. Let's go back to where we were. Okay, 63, 64. So we don't think it's going to go above 65. We don't think it's going to go below 61. Hypothetically speaking, you know, this is not exact science. Now, credit spread. Why would I sell that credit spread? I'd be out money right there because I'd have to pay somebody that 2 cents per share. So why would I sell that? That boggles my mind. You know, to be totally honest with you, it's a little too much for me to go calculating right now at the moment. For some strange reason, my mind's not functioning properly. It's like we believe that the stock is going to stay right in this trading range between 62 and 65. So if I sell someone 65 and a half, 65 and a half, and I 65, I sell someone 65 and I buy the 65 and a half, it's only a 2 cent credit. That's not a whole heck of a lot, not even worth my time. You know, I'm making 23 bucks. It's costing me $2,400 to make that one. I don't think so. That one don't look good either. Making 53 bucks and it's costing me 430. That's not a good one either. Yeah, to sell this one, making 160 bucks, and it's costing me 340. Well, now this one, it's easier to understand. You know, the debit spread. You know, you're buying it for 40 cents, and the most you can make is 50 cents, as long as stock stays above 63.50. And right now it's at 63.83. So if the stock goes up, you make money. If the stock stays the same, you make money. And the stock can go down a little bit, and you still make money. And how much are you making off of that? 40 cents. Make $100 off of gotta make it worth my while. 100 bucks is not worth my while. Okay, 50 contracts. All right, you're making 500 bucks. It's costing you 2,000. That's a 25% return. A 25% return for 5 days. Okay, now a 25% return, it's a nice return. And look, she's in an uptrend now. She's got the dividend coming up in 5 days. Okay, how can you really go wrong? Well, you can, you know, it happens. You know, there's no guarantee that it's going to go up. I mean, just because the charts, the stocks, and just because of the charts, the graphs, and even the software all says it's going to go one direction. Is it always going to go in one direction? No, it's not always going to go one direction. It can go up, it can go down, or it can go sideways. The nice thing about this particular trade, the ones that I've been doing, is you can make money if the stock goes up. You can make money if the stock doesn't move at all, and you can make money if the stock goes down a little bit. I mean, that is a great trading strategy. But let's get back to the four-corner credit spread, because I've heard about it only from one person. I do some research on it. I can't find any research on it, but it makes sense theoretically. But which four corners do you trade? Okay. Let's just do single. Now, if we think it's going to stay between 65 and 62, oh, if I sell that one, that means somebody could buy it from me at 62, which I would have to buy it at 63.83. That doesn't make any sense. Wait a second. That doesn't make any sense either. You know what? I'm going to apologize for you guys now. I'm going to do some more research on this four-corner credit spread and try to find out exactly what is the right strategy to do it. It's got to be there somewhere. I know that I'm going to do a little bit more research before I can talk eloquently of this thing. So, all right, so let's get back to the market watch and find out who. Now, Mark got a nice position right there. I just showed you 25% return you can get on that Biolab. Let's take a look at Biolab real quick. The Biolabs is still possibility. No, it ain't. Look at that. Follow that trend. No, thank you. Tech, T-E-C-K. That looks nice. Look at that. Nice movement on the upside. T-E-C-K. Tech. Let's delete that. What's tech looking like seasonality wise? Here we are right here. I don't know about you, but that looks like a buying opportunity right there. Okay, and tech's at 25.46. Whoa, that's a nice one right there. It's another 25% return. Most you can make is $500. You got to put up 2,000 bucks. And as long as the stock stays above 25. That's a 25% return. Okay, I like that idea. Back to the market watch. Okay, now we looked at most of these last week. What do we have coming up this week? Okay, with that Best Buy, cool. AVGO, Broadcom Limited, STX, was that Seagate Technologies, and Tiffany's. I like Tiffany's. And this is Las Vegas Sands, something like that. Yeah, Las Vegas Sands Corporation. Okay. Let's see what Las Vegas Sands Corporation, LVS. This time of year, LVS. Ooh, look at that. Now that, my friends, that is like a buy signal right there in and of itself. Okay, and let's take a look at LVS and see what those numbers look like. Let's drop down, take a look at the regular chart. Here's the regular chart here. LVS starts out at the high of the year at 81. So, you're not at the high of the year, you're not at the low of the year, you're smack dab in the middle, in an uptrend. That's pretty darn cool if you think about it. Oh, and this is the 10-year chart. So, does it look like something you want to hold for the last time? No. Something you want to invest in, because she's back up on an uptrend, and I like that, back on the uptrend. Okay, so she is basically going sideways, but she's in an uptrend right now. So is that continuing up? I don't know. 67.50 or 62.50, 62.50 right here. Oh, that's more than 25% return. Look, you can make $120 off of a $400 investment. So that's what, 28, 29%. That's a nice return. That's only 10 shares. I mean, 10 contracts. Jump up to 50 contracts. What are we looking at? $600 for a $1,900 investment. That's just a little bit under 30%. So that's probably, wait a minute, 600. Yeah, that's more than 30%. So that's like 31, 32%. So you get a 32% return on your money for a week investing in this company, as long as she stays above 62.50. Now, can she go below 62.50? Of course she can. She can go through the roof. She can drop to the floor. She can go side. She can flatline, go sideways, do absolutely nothing. You don't know. I mean, the seasonality says that she's going to make the move this time of the year. Look at that. A nice little peak. But does that guarantee it? No, it doesn't. The 10-year chart. Let's get back to standard. This is what she's been doing. This is what she's been doing for the last 10 years. I mean, 10 years ago, about 10 years ago. Wait a minute. The date's right here. See the date right there? The high of May 2014. 2014. That's only 3 years ago. That's 10 years ago. Yeah, 2007. Look at that. 2007, this baby's at 146. Low at 2009, 81 cents a share. Holy cow, are you kidding me? Really? Wow, how would you like to buy the Sands, Las Vegas Sands back then? Oh. Okay, so this is what she's been doing for the last 10 years. 40, then to 45. Come on, you're just going too darn slow. So 45, then to 60, then she dropped back down to 40, up to 55. Oh, past 60, 70, 80, 85, almost at 90. Then she drops back down to 62. 2012, and then back down to 40. Ouch, this baby's all over the place. But what are we looking to do? We're looking to hold on to it just for 2 or 3 days. Come on. Do I really want to own it? No, I don't. I want that spread. I want that little tiny piece of the pie. Don't want a huge amount. Don't get me wrong. If you're going to give it to me, why not? I'll take it. But that's not what I'm looking for. I'm looking at odds and probabilities. The odds and probabilities at this moment in time with the data that I'm looking at is a 30% return in 5 days. Okay. That being said, I'm going to check, see if I have any questions. If not, I'm out of here for the evening. No questions. Gotta love it. So that being said, we be out of here. This is James from Dividend Stock Talk. We talk about dividend stocks and investing in dividend stocks for weekly and monthly cash flow. This is James. I'll catch you guys next time. I'm out of here.